Stop what you're doing right now because something just shifted in the gold and silver market that most people are completely misreading. Before we start, quick disclaimer, everything you're about to hear is strictly for educational purposes only. Nothing in this video should be considered financial advice. Always do your own research and consult a licensed financial professional before making investment decisions. Now, with that said, something interesting is happening in the silver market right now. For years, silver investors have been waiting for demand to explode, waiting for supply shortages, waiting for the moment when the market finally wakes up. And slowly, quietly, that moment might be starting. Industrial demand for silver has reached record levels in recent years. Solar panels alone now consume hundreds of millions of ounces of silver annually. Electric vehicles require silver for advanced electrical systems. AI hardware, high-end electronics, medical technology, and defense manufacturing all rely on it. Meanwhile, global mine supply hasn't kept up. Industry reports from organizations like the Silver Institute have repeatedly warned that the market has been running structural supply deficits, meaning the world is using more silver than it is producing. That's the kind of imbalance that historically creates powerful commodity bull markets. And investors are starting to notice. Coin dealers across the United States have reported waves of new buyers entering the precious metals market. People who never owned silver before are suddenly asking questions. How do I buy silver? Where should I buy it? What kind should I buy? And that last question is where things start to go wrong. Because here's the truth, almost nobody explains clearly to new silver investors. Not all silver investments behave the same during a bull market. Two people can both buy silver, and one of them might make twice as much money as the other. Not because they timed the market better, not because they were smarter, but simply because they bought a different type of silver. That's what today's video is about. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. There are three types of silver you should be extremely careful about during a bull market. And the second one is the one most people already own. Before we dive into them, I want to ask you a quick question. What kind of silver do you currently own? Is it American Silver Eagles, silver bars, generic rounds, maybe even a silver ETF in your brokerage account? Drop your answer in the comments below, no judgment. Because by the end of this video, you might look at your silver stack very differently. And if you're new here, consider subscribing to the channel. Because understanding markets isn't about following hype. It's about understanding how money really moves. All right, let's start with type number 3. Type number 3, the beautiful trap, collectible silver. Let's imagine a simple scenario. A new investor walks into a coin shop for the first time. They've been hearing about silver everywhere. Maybe a friend mentioned it. Maybe they watched a few YouTube videos. Maybe they read about industrial demand rising. Whatever the reason, they decide they want to buy some silver. They step up to the counter. The dealer greets them politely and asks what they're looking for. "I want to invest in silver," the customer says. The dealer nods knowingly. Then he pulls out a small box. Inside the box is a coin sealed inside a hard plastic case. The label reads something like MS65, 1881 Morgan silver dollar. The coin looks stunning, bright, historic, impressive. The dealer begins telling the story. This coin was minted over a century ago. It survived wars, economic crashes, and generations of history. It's graded in near-perfect condition by a professional grading company. It's not just silver, it's history you can hold. The buyer feels something powerful in that moment. Pride, excitement. The feeling of owning something rare and important. Then the dealer mentions the price. $400. The buyer hesitates for a second, but then they think, well, silver's going up, and this coin is rare. So they buy it, and they leave the store feeling like a sophisticated investor. But here's the math nobody stops to calculate. A Morgan silver dollar contains about 0.77 ounces of silver. If silver were trading at $30 per ounce, the metal value inside that coin would be around 23, so yet the buyer paid $400. Now let S be clear about something. Collectible coins are not scams. There are entire communities of coin collectors who study rare coins, trade them, and build valuable collections. Some rare coins sell for thousands or even millions of dollars. But collectible coins belong to a completely different market than silver bullion. Collectors care about rarity, mint marks, condition, and historical significance. Bullion investors care about one thing, the price of silver itself. And during a silver bull market, the metal price is what moves. Let's imagine silver doubles. That's not impossible. Silver has done it before. If silver goes from $30 to $60 per ounce, a simple 1 ounce silver round might double in value. But the collectible coin, the silver inside might increase slightly. But the collectible premium, the extra hundreds of dollars you paid, might not move at all. Why? Because collectors aren't buying coins based on industrial demand. They're buying them based on rarity and condition, two completely different forces. And here's something even more interesting. During intense bull markets, collectors often step back from the market entirely. Prices become volatile. Speculators flood in, collectors wait patiently for calmer conditions. So the buyer who paid $400 expecting silver to explode upward might discover something frustrating later. When they try to sell it, dealers might only offer a small portion of what they paid, not because silver collapsed, but because the premium they paid was never tied to the silver price in the first place. This is why many experienced silver investors separate two very different hobbies: coin collecting and silver investing. Both are legitimate, but they are not the same thing. If your goal is riding a silver bull market, paying enormous premiums for collectible coins is often the wrong strategy. Which brings us to type number 2. And this one is where things get uncomfortable for a lot of people. Type number 2, the premium problem, government coins. If you've ever bought silver before, there's a good chance you own this, government-minted silver coins. Coins like American Silver Eagles, Canadian Maple Leafs, British Britannias, Austrian Philharmonics. These coins are beautiful. They're official. They're recognized worldwide. And for many investors, they feel safer than generic silver products. After all, they're produced by sovereign mints. So what's the problem? The problem is something called premium expansion. The premium is the extra amount you pay above the actual silver value of the coin. And during bull markets, premiums can explode. Let's walk through the math. Imagine silver is trading at $30 per ounce. In a calm market, an American Silver Eagle might sell for $34 or $35. That's a reasonable premium. But when demand surges, those premiums can climb dramatically. During past bull markets, American Silver Eagles have sold for $10, $15, even $20 above spot price. That means investors might be paying $45 or $50 for a coin that contains $30 worth of silver. That's a 50% premium. And here's the dangerous part. That premium isn't guaranteed to stay high. In fact, it almost never does. When market excitement fades, premiums usually collapse back toward normal levels. This happened very clearly after the 2011 silver spike. When silver approached $50 per ounce, demand exploded. Dealers struggled to keep coins in stock. Premiums skyrocketed. But when the market cooled down, premiums fell rapidly. Even investors who bought near the peak silver price sometimes lost money simply because the premiums disappeared. The silver didn't even need to crash. The premium contraction alone was enough. This is why experienced silver investors often adjust their strategy during bull markets. Instead of chasing prestige coins, they focus on something much simpler: getting the most silver possible for every dollar spent. Which brings us to the final category. And this one might be the most controversial of all. Type number 1, paper silver, the invisible asset. Let's talk about paper silver. Millions of investors own it. It's incredibly popular because it's easy to buy. You can purchase it instantly through a brokerage account. You don't need storage. You don't need insurance. You don't need a safe. We're talking about things like silver ETFs, silver futures contracts, pool accounts, unallocated storage programs. On paper, it looks exactly like owning silver. You buy shares. Your account shows the value rising and falling with the silver market. It feels like you own silver, but the reality is more complicated. In many cases, what you actually own is a financial instrument linked to silver, not the physical metal itself. These instruments rely on custodians, vault operators, financial institutions, and legal structures. Under normal conditions, that system works just fine. But commodity bull markets sometimes expose an uncomfortable truth: the difference between paper claims and physical assets. Financial markets can create far more paper claims than physical commodities. That's true for gold, it's true for oil, and it's true for silver. During normal markets, nobody worries about this difference. But during supply crunches, physical commodities can begin trading differently from paper contracts. That's why many longtime precious metals investors follow a very simple principle. If you cannot take possession of the metal, you may not truly own it. Physical silver is tangible. It cannot be created with a computer entry. It cannot be printed. It must be mined, refined, and delivered. That physical reality is what gives commodities their long-term value. And during major bull markets, physical ownership often becomes far more important than people expect. So if collectible coins are risky, government coins can have massive premiums. And paper silver isn't always the same as physical metal. What should investors actually buy? Most experienced silver stackers focus on one principle: maximum metal, minimum premium. That usually means 3 things: generic silver rounds, silver bars, and constitutional silver. Generic rounds are simple 1-ounce silver pieces produced by private mints. They don't carry government branding, which keeps premiums lower. Silver bars operate on the same idea: 10-ounce bars, kilo bars, even 100-ounce bars for large investors. The larger the bar, the smaller the premium per ounce tends to be. And finally, constitutional silver. These are US coins minted before 1965 that contain 90% silver, dimes, quarters, and half dollars. They're widely recognized and easy to trade in smaller amounts. For many stackers, they offer flexibility that large bars don't. The common theme across all three: more metal for your money. Because during a bull market, it's the metal that moves, not the packaging, not the prestige, just the silver itself. Here's the truth most people eventually learn about commodities. Bull markets reward people who understand what actually drives price. And in the silver market, that driver is the metal, not the story behind the coin, not the brand name on the mint, not the promise on a brokerage statement, just silver, real, physical, measurable silver. So take a moment and think about your own silver holdings. How much of your money went into actual metal, and how much went into premiums? If the answer surprises you, that's okay. Every investor learns over time. The important thing is learning the lesson before the market does it for you. Now I'm curious, what type of silver do you currently own? Bars, eagles, rounds, something else? Tell me in the comments below. And if you enjoyed this video, make sure to subscribe. Because the silver market is changing fast, and the people who understand it early are the ones who benefit the most. Thanks for watching, and I'll see you in the next video.